Welcome to this Killick Explains video. This week I want to take on how investors become gamblers and then stress all the reasons why they shouldn't. Now the background to this is what? Well, in a nutshell, stock prices have recovered sharply from their recent virus lows after a huge plunge earlier in the year during the spring. Following the outbreak of the virus globally, most stock markets have put in substantial gains, in some cases recovering to their previous levels and even going beyond. And this has spawned a new army of day traders, people essentially who've looked at the market recovery and thought there's an opportunity to make 10 or 20 years of money in just a few hours or just a week. These, however, are gamblers rather than investors, so watch out for the advertising straplines. What these people are doing is not investment in any conventional sense, and you should be very wary of joining their number. Now the backdrop to this is what? So where has the temptation come from? Well, the initial impact of the virus was to send stocks down by over 35%, depending on which index and which market you look at, in the space of a few weeks, about a month, earlier in the year. However, since then, some shares have rocketed to the extent that the American Nasdaq index, for example, which is technology dominated, has actually hit new highs in a matter of a few months. And that has created a backdrop where people have seen stocks linked in any way to solving the coronavirus problem and or technology being turbocharged in terms of the way they've behaved. As people have basically looked around the world and tried to identify companies that might be able to come up with a vaccine, anything linked to a solution to coronavirus, so that has driven some almost insane stock valuations and stock movements. Now there are countless examples, so temptation awaits everywhere, seemingly. I'll just give you 3 examples. This is 3 from 100 I could have chosen. So we've seen in Korea, Shin Pung Pharma up 969% year to date as at the 6th of August. Another example, and there are plenty, closer to home, on the 20th of July, just to pick one day, Synergen more than doubled between 9 a.m. and midday. And then we've got Eastman Kodak, a stock that many people had written off until fairly recently, connected with possible coronavirus solutions, and the stock rose over 1,000% in just over a week in late July. Now, as I just stressed, that's just 3 examples. There are many, many others. So, who is facilitating this army of day traders, new investors, into the market, trying to exploit these huge movements in individual shares? Well, the answer is digital platforms that have been around for a while allow almost anyone to trade quickly and cheaply, inside or outside a tax shelter, such as an ISA or a SIP. So there are many ways, tax effective or otherwise, of jumping in and out of stocks. And then you've got the arrival of new gamification apps such as Robinhood, claiming to offer investing for everyone. And these try and make investing in single stocks not only straightforward, but also as much fun as possible. And accounts on most of the new platforms can be opened quickly, and advertised costs at least are kept low to bring in customers. So these are people offering the ability to get into single stocks rapidly and also cheaply. Now what's the problem? Well, investing in single stocks over short time periods, whatever the advertising strapline may claim, is not investing. And many investors who've jumped onto this bandwagon have no idea why a stock is rising, or even what the underlying company does for a living. A friend of mine who was asking me about this recently has actually referred to bandwagon trading, otherwise known as momentum trading, which is simply joining a ride with no idea about the underlying mechanics of the company, how it's linked to a coronavirus solution, what sort of technology it offers, and so on. And you might be thinking, well, so what? If the stock's rising, who cares? Well, the answer to that is that in any stock market reversal, losses could be up to 100% of your investment, and that can happen very, very quickly indeed. The stocks that have risen furthest and fastest are by definition the ones that are likely to fall hardest and fastest too. And remember, in the stock market, you can be wiped out. You can put £2 into a share and lose all of it. Don't be fooled by the "it can't get any cheaper" line. Until a share hits zero, it certainly can. Now, what's behind the temptation? Why are so many, normally quite reserved, sane people, tempted to join the bandwagon, as my friends called it? Well, it's human nature. And I'll just give you 3 examples of what I mean by this. We like to follow the crowd. Most of us prefer to follow the crowd rather than stand back and take a more sanguine view. And that goes back to our times on the savannah, if you like, when staying with the crowd was actually a survival mechanism. We're impatient. I mean, why, if you could make double your money in a morning, as I suggested earlier, would you possibly want to wait 10 or 20 years for a steadier source of return? Jam today rather than jam tomorrow. And we love a story. Now, stories come in many forms, but we love the idea that there are stocks out there that were obscure ones that no one else has discovered that have now solved the global pandemic problem. And crikey, we all want that to happen, but we love the idea that we've stumbled on the company that's going to do it. And it's a lot easier to follow a story, to follow something you've heard down the pub, over the internet in a chat room, for example, than it is to actually do the hard work, roll up your sleeves and get to the bottom of what actually underpins a stock price and its subsequent journey. So, just a reminder, what is gambling? Because I've always said gambling and investment are not the same thing. Gamblers tend to follow this pattern, and if you find yourself doing this, you have become a gambler. So 1, you back hunches. You don't do your homework. You don't investigate sets of accounts. You don't look into a company's management team, product development history. You back a hunch. You trade often. Frequent traders are often gamblers. They're looking to get in and get out. And basically, you get lucky or you get wiped out. So the problem is that the people you tend to meet who have got lucky are the ones who tend to tell you about how they rode an incredible stock market rise. The ones who get wiped out or lose money tend to keep quiet. So in other words, survivor bias is something that humans are prone to. We tend to hear about the successes more than we hear about failures. So what are long-term investors by contrast? And this may feel like you've heard it before, but it is worth reminding people about what long-term investing actually means. You do your homework. You don't back hunches. Or you pay someone else to do your homework for you. But ultimately, this is detailed research. It's a little bit dull. It's a little bit time-consuming. But it's based in fact, not in opinion, if you like. You diversify. You hold a portfolio of diversified stocks. Now, this means you diversify across sector, across theme, potentially across currency, globally, as well as nationally. And it involves taking a position, well, the capital asset pricing model would suggest of at least 15 to 25 stocks. Some people will hold a lot more. An index will obviously hold a lot more than that. A few people will hold fewer, but it is not single stock gambling. And finally, long-term investors avoid market timing. They agree that they are not going to get market timing right. It's incredibly difficult to do. It involves luck more than judgment, and they take the view that they will ride out any dips in the market over the long term with a solid stable of well-chosen, well-diversified stocks. So there you have it. I would urge anyone who has been an investor up to this point not to be drawn into day trading style gambling. If you've got any questions on that or the differences between the two, then it's editor@killick.com. And if you'd like to watch videos that explain how to invest long term in, for example, equities successfully, then it's killick.com/learn. And finally, I just mentioned my Killick Explains guide on how to invest in equities, which is available again at the email address I mentioned just now.